An asset is something that has value and can be owned or controlled to produce future economic benefits such as cash, property, or investments. A liability is a promise to pay money or give goods and services in the future. Examples of liabilities include loans, mortgages, and accounts payable. In short, assets are resources owned by an individual or organization, while liabilities are debts or obligations owned by an individual or organization. Your goal is obviously to accumulate as many assets as you can and as few liabilities as you can. In this video, we will explain the difference between an asset and a liability in more detail and give you tips on how to get more assets and get rid of liabilities. It's important to understand the distinction between an asset and a liability. An asset in financial accounting is a resource that can be used to make money. The distinction between the two is frequently overlooked. A house is an asset if you want to sell the property. This is a classic illustration. It is a liability, and because of the mortgage, it can take you years to pay it off. Also, there are maintenance costs that you are going to sustain on a monthly basis, which will not put money into your pockets. On the other hand, if you plan to sell the property for more money than you bought it for, that can be seen as an asset. If you pay for an investment, you can call it an asset, since an investment is anything that gives you a return on the money you put in. Many people still talk about this, saying that you can sell the car later and count it as an asset. Buying stocks and bonds is an example of buying an asset, because you can get dividends from them or sell them for a profit through capital gains. Another interesting example would be buying a car when the price goes down. Used cars are worth far less than new cars, and it would be foolish to consider them an asset. Many people still talk about this, saying that you can sell the car later and count it as an asset. However, as you will learn, a good asset also needs to generate profit. A car that rapidly depreciates is not to be considered an asset, whether you can sell it in 2 hours or 2 years after buying it. It will not be profitable because you will not sell it at a higher price, but there are some exceptions. There are historic or classic cars that generally have value, but generally we are not talking about those cases. We are talking about what most people would buy, which is a day-to-day car that they can drive for personal purposes. There's a difference between tangible and intangible assets. Tangible assets are what most companies use to make their products and services. Intangible assets, on the other hand, don't have a physical form, but they still have monetary value because they represent monetary value. An example of an intangible asset would be the copyright to a song. The record company that owns the copyright would get paid royalties every time a song is played. These are often confused and not separated. People just lump them together as if they're the same thing that will bring the same profit. However, that's not how reality works. Real assets have an intrinsic value. The intrinsic value is the real value of an asset without any market influence, which is why they are called assets. Financial assets use the market trading price to define their value, which means you can easily end up paying more than they are actually worth. This isn't a great move because you will lose money instead. This is why people like Warren Buffett talk a lot about finding out the intrinsic value of a company, and you will know if a stock will cost more than its real value. The intrinsic value of a company is an estimate of its true value based on its fundamental characteristics, such as its financials, assets, growth potential, market position, and industry trends. In other words, its estimated value of a company based on its own internal factors rather than external factors such as market sentiment or investor speculation. It's calculated by analyzing financial statements and projecting future cash flows, earnings, and dividends. If the market price is lower than the real value, you will almost certainly make money when the market price gets close to or goes above the real value. Financial assets, on the other hand, derive their value from contractual claims. Two examples would be stocks and bonds, which we will explain shortly. Stocks and bonds are considered tangible. Financial assets are also easier to convert into cash. Assets like real estate and other commodities are harder to cash in on. Stocks are known as the mother of all assets, and if you do not know how they work, we are going to explain it simply enough that you will 100% understand them by the end of this video. Stocks are the most well-known assets, and they have huge potential for those who know how to invest in them. When you buy them, you are buying a small percentage of that company. Imagine having a house and buying one brick. You are now part of that household because you own that brick. Hey, wait a minute. Why on earth would you want to own a brick? Well, give us a minute and we will get there. We need you to understand that when you buy stocks, you are becoming an associate of that company. And if you own enough shares, you own a bigger slice of the company. You can also have voting rights when the company makes an important decision. There are two ways to make money with stocks. The main one being by making a profit. The first way is the most common method, and it involves using capital gains. This means that you have to buy stocks and wait for the price to go up, then sell them. For example, you can buy stocks for $5 and sell them for $7, which would give you a profit of $2. Prices don't always go up though. They fluctuate, and that's what the share price graph represents. Prices can go up and down depending on supply and demand in the market. The more demand a stock has, the more it'll cost. If you think a stock will grow in demand in the future, you should buy it because it's going to rise in value, which means you can resell it at a higher price. However, you should be careful if your predictions are wrong. And if the price goes down rather than up, you will lose a ton of money. Many people consider this as a gamble, but if you know what you're doing and you evaluate the companies that you buy, you should make a lot of money most of the time. The second method is to make money with stocks by using dividends, which are issued yearly, quarterly, or twice a year. Dividends are the equivalent of your ownership in that company. As an example, if you buy one brick out of 100, your profit on that house will be 1%. Does it make sense? How do you acquire stocks? The easiest way is to open an investing account through an online stockbroker. Your bank probably offers these services, and you can invest the old-fashioned way with your bank directly. Fees are applied in both cases, and every transaction is regulated and taxed. Assets are often grouped based on their liquidity, or how quickly they can be turned into cash. The most liquid asset on your balance sheet is cash, since it can be used immediately to pay a liability. The opposite is an illiquid asset like a factory, because the selling process is lengthy. The most liquid assets are called current assets. Cash, securities that can be sold, inventory, and accounts receivable are all examples of assets that can be turned into cash in less than a year. These assets generate revenue for your company. Non-liquid assets are grouped together in the category of fixed assets. These include real estate, vehicles, and machinery. Fixed assets contribute to the income but are not consumed in the income-generating process and are not held for cash conversion purposes. Fixed assets are things that can be seen and touched. They usually cost a lot of money up front and last for a long time. Liabilities are obligations or debts that an individual, organization, or company owes to another party. There are different types of liabilities, including, first, current liabilities. These are short-term debts that are expected to be settled within 1 year or within the normal operating cycle of a business. Second, long-term liabilities. These are obligations that are due after 1 year or beyond the normal operating cycle of the business. Most of the time, current liabilities are amounts that are owed for things like accounts payable, wages, and taxes. In addition, payments on long-term debt in the next year will be listed in current liabilities. For example, if you have a 30-year mortgage on your building, the next year's worth of payments will be listed in the current liabilities section, while the remaining balance will be shown as a long-term liability. If you are a small business owner, one of your most important goals will be to balance your books. This means you need a solid understanding of assets and liabilities in order to make good decisions and evaluate the health of your business. Once the terms are defined, understanding assets and liabilities is fairly easy, and the financial reports you've been generating will start to have more meaning. Thank you so much for watching Legend Finance. If you are someone who hungers for more tutorials about personal finances, come and follow our channel to see more of our content. It was good to see you today, and we hope to see you again in our next video. Bye for now!